Comex and the LBMA are the ones that are losing credibility. The only reason to have it on a blockchain as an investor, I guess, would be for ease and collateralization. If you don't need collateral and you don't care about, the benefits of having that type of platform, I think you're better off holding it at home, myself, or burying in the hole in your backyard. Or
the transfer, if you like, between savers and borrowers. The point about a collapse in the currency is it robs the savers and it benefits the borrowers. But you've got to be able to continue to manage your credit obligations.
In today's news recap, silver price soars past $60 for new record. Silver notched another record high on Tuesday as the precious metal continues to attract bids amid concerns over a market deficit. Spot silver rose as much as 3.6% to a new peak of $60.46 per ounce, keeping the momentum of a record-breaking rally that has lasted nearly 2 months. Driving this surge was a supply crunch caused by a historic squeeze that hit the London market in October. While that concern has eased in recent weeks, global supply remains tight, with Chinese inventories now hovering at their lowest in a decade. What do you think, you guys? Are you buying even more at these record prices? Also, behind the move was the expectation of a U.S. interest rate cut this week, which would be positive for safe haven assets such as gold and, by extension, silver. The white metal is getting a bid this morning alongside gold ahead of the Federal Reserve meeting, with the market pricing in near certainty of a 25 basis point cut, said Trevor Yates, a senior investment analyst at Global X ETFs. Silver first surpassed its October peak in a choppy trading session as a chaotic halt on the Comex exchange in late November dried out liquidity. The holiday season and low physical trading in London's over-the-counter market also amplified price moves. Tuesday's rally takes silver past the $60 an ounce mark for the first time ever. The metal has now doubled in value this year, even surpassing the 60% gain seen in gold. Now smash the subscribe button, turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio so you do not have to rely on market commentators to stack efficiently. Let's get back into the episode.
This is actually a very interesting record you've produced. And it illustrates the problem, because the reason that fiat currencies die is that governments cannot resist the temptation to print, if you like, print credit. And the other side of that credit, of course, is the debt, which you've just run through and shown how it has been growing. It gets to a point where it can no longer be sustained. And it's at that point that a fiat currency dies. So that's roughly where we are. And the idea of the debt bubble bursting, yeah, that's absolutely right. And the way in which it happens is that the purchasing power of the units in which the debt is denominated deteriorates and deteriorates, and in fact ends up collapsing if nothing is done about it. This was the fate of the Reichsmark in Germany between 1920 and 1923. It very often happens in sort of slight phases, but I think we're getting into a rather dangerous endgame here, which really means that when it bursts, not only does the debt bubble burst, but it takes the credit bubble with it. So that's what happens to stocks and shares. They are sustained by this credit bubble. They will collapse with this debt bubble imploding. And at the same time, because the only way in which governments politically can respond is to try and rescue the banking system, to underwrite the entire economy, etc., etc., they've given themselves that function, if you like. The consequence is that the expansion of credit at that stage in the form of currency is just going to go through the roof. It's bound to. And so the purchasing power of the currencies, and this is the key point to understand, it's the purchasing power of those currencies which collapses. Of course, we think that you get a hyperinflation and all the rest of it. No, that's just looking at the symptoms. Really what you've got to look at is how the purchasing power of the currency collapses. Then you can understand the process. it drives up bond yields. That was one point you made, and I noticed that the Australian 10-year bond yield has risen 0.5% in the last 6 weeks. That's it's rather leading the way along with Japan. I mean, the Japanese bond yield really soaring now, and the consequence of that is that it's undermining the carry trade, upon which the purchases of US Treasury really do depend. So you've got the potential for rising bond yields triggering, if you like, a debt crisis. And I think that's probably not too far away from here. The other point that you raise is, do you believe what will be the effect on our living standards? It will be so destructive of our living standards. It will be horrid. I mean, there's no two ways about it. And the only way in which you can protect yourself from the economic destruction that the collapse of a fiat currency brings about is to hold real money, which is definitely gold. Silver less so. Silver has the traditional role of being a monetary metal. And I have absolutely no doubt that people will go into silver in increasing numbers once they begin to realize the risk that's inherent in credit. And of course, the other thing is that if you look at bond yields as a whole, they will rise and rise and rise because they reflect the risk of lending, bank lending, if you like, bank lending, or even buying bonds, whether you're going to get actually repaid at the end of the day. And furthermore, what is the value at the end of the day of a loan? If the purchasing power of the currency in which it's denominated is collapsing, then are you happy with 5%, 10%, 20%, 30%, 100%? I mean, this is the reality of what happens when you have a currency collapse, a credit collapse. And the only way out of it, really, is to ensure that you can feed yourself and to ensure also that you are out of credit and into real money as much as you possibly can.
In today's news recap, central bank body BIS raises concerns of gold and stocks double bubble. The combination of gold and share prices soaring in unison is a phenomenon not seen in at least half a century and raises questions of a potential bubble in both. Global central bank umbrella body, the Bank for International Settlements, says, while equity markets continue to be driven by AI and tech gains, gold's 60% surge this year is set to be its biggest since 1979, fueling debate about whether its traditional role as a safe haven asset has changed. Gold has behaved very differently this year compared to its usual pattern. Hyun Song Shin, economic advisor and head of the Monetary and Economic Department at the BIS, said as it released its final report of the year on Monday. The interesting phenomenon this time has been that gold has become much more like a speculative asset. Dubbed the central bank to the world central banks, the BIS has given regular warnings about potential stock market bubbles in recent years, but its concern around the co-movement with gold is twofold. Where would investors shelter if stocks and gold both crash? And what could it mean for central banks and other reserve managers, given some have been heavy buyers of gold? The BIS's analysis concluded that this year has been the first time gold and the S&P 500 have jointly exhibited explosive behavior in the last 50 years. Now, smash the subscribe button, turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio so you do not have to rely on market commentators to stack efficiently. Let's get back into the episode.
I said to him, there are just a very few things that need to make this work. Number one, it has to be transparent. Obviously, that's the whole premise of blockchain. So that's nothing profound. But it has to be transparent in the respect of who's holding the gold. Is it an institution like Brinks or the Royal Canadian Mint or some major mint, the Perth Mint, the US? Who's holding it? In what form is it held? Who's auditing it? And the key to it all, in what form and how easy is it for me to take delivery? And that's the most important part. In other words, any exchange that doesn't allow delivery or any platform that doesn't allow delivery, it's fugazi. You can throw it right out the window right now because it ain't going to work. The whole premise of the whole reason the LBMA and the Comex have worked, even though they've rigged the system, is that they allow delivery. Even though no one ever stood for delivery way back when, they do allow it. That is the key. And if you want to really come out the gate screaming, who owns it, who audits it, what form, and how easy and what form can it be delivered? Those are the things that could very quickly tip the scales. And I think when a system loses trust, and I think this has been an overreaching theme that you and I have talked about for a while, this whole country, this whole thing, you know, I mean, it's not just the country, it's everything about it: judicial system, electoral system, immigration system, wokeness instead of meritocracy, all the stuff we talked about ad nauseum for years, especially during the previous administration. And then on top of it, sanctions, well, you call them tariffs, but they're actually sanctions masquerading as tariffs. The way that this administration, and granted, I'm glad he won and I would vote for him again, but there are some things he is doing that is eroding trust, even with our allies, by placing tariffs on Mexico and Canada and the EU. And, you know, there are things, this whole system is about, I think, a fraying of trust. And so if you want to make this work, it has to be completely and totally trustworthy. And that would be being very open and transparent about all of those things, including who's auditing it, how easy it is to see the audits, and if I want to stand for delivery, in what form, and how easy is it for me to do that. If those things all became relevant, then yeah, because I think we're reaching a point in time where the Comex and the LBMA are losing trust globally. And that's why you see everyone standing for delivery the way that they are, because these countries don't want paper promises anymore. I think they want the real thing in their possession, and that's more important than anything else to these players. So, yeah, if done the right way, to your point, which is a valid one, then I think it has legs. It really does.
Do you agree with him? Are you still bullish in gold and silver? Is a massive collapse going to happen in 2026? Post in the comment section down below your honest opinion. Subscribe if you have not yet done so. And watch this video right here because it's a perfect fit for you. I'll see you on the other side.